Okay, hi, welcome back to the second part of chapter 5, and we're going to talk about the basic annuity. So, what is annuity? Annuity is a series of cash flow of the same amount received or paid on each period. So, basically, you have a same amount of money each time, right, in the future. So, um, for many years, right? So that's what we call the annuity. And then the most important thing that we wanted to know about annuity is what is the present value of money that you invest, and then can support the multiple period of payment or recipients, right, money, right? So at first we wanted to know what is annuity. Annuity is a series of cash flow of the same amount, either received or paid. So an example can be a loan on which periodic interest is paid to equal amounts, or a lease paid in equal installments during a specific time, right? And there's two kinds of annuity. One is called the ordinary annuity, another called annuity due. Ordinary annuity means that cash flow occurs at the end of each period. And annuity due means the cash flow occurs at the beginning of each period. Okay. Ordinary annuity, for example, an installment of notes payable dated at the December 31st, 2021, might require the debtor to make 3 equal payments, with the first payment due on December 31st, 2022. And last one to be on the December 31st, 2024, right? So that means that you owe someone some money at December 31st, 2021, but they require you to pay 3 times. Each time is the end of each period. So the first time you have a cash outflow is at the end of the year, and then second payment and third payments. So annuity due, let's see this one in another example. Annuity due, for example, a 3-year lease of a building begins on the December 31st, 2021 and ends on December 31st, 2024, may require the first year lease payment in advance of December 31st, 2021, and the last payment would have taken place in December 31st, 2023, which is the beginning of each period. In other words, if you're leasing something, you're going to pay ahead of time. So therefore, it's called annuity due. Then the first payment is happening right now, right, when you have the lease. And the last payment is going to be happening before the year end of the third year, right? Okay. So the first thing we wanted to know is how do we calculate in future value of an ordinary annuity. For example, Rita Grant wants to accumulate a sum of money to pay for the graduate school, and rather than investing a single huge amount today will grow into a future value, she decides that she wants to invest in $10,000 a year over the next 3 years in a saving account paying 10% interest and compounding annually. Then she decides to make the first payment to the bank 1 year from now. So based on the first payment to the bank 1 year from now, we immediately know this. This means that the first time that she pays is at the end of the first period. So that's a standard definition of ordinary annuity, right? So how do we calculate it? So first payment, let's use our knowledge from first chapter. So first section, right? First part of this chapter is that first payment is going to be $10,000, right? And the period of the first if you wanted to know how much money right here is, right? So the first period is $10,000. It's accumulated compounding for 2 periods, right? And the 2 period, if you look at the future value table, you find the I equals 10, N equals 2. Then you know that the future factor is 1.21. So that means the future value is going to be $12,100 on the year end of year 3. And then the second payment, which is this one, it's gonna be compounding at one period, n equals 1, because this is from here to here, right? This is from here to here. So that means that if you find that table, the compounding rate is 1.1. So therefore, the end of the future, the third year, the future value is 11,000. And the last period is actually end of right on the end of third year. So there, the future value table should only multiple future factor of 1. So therefore, if you're adding this 3 up, okay, this is 3.31 up, or you're adding this 1 up is 33,100. So by looking at this, we know that the ordinary annuity of $1 at 10% for 3 period is 3.31, right? So therefore, similarly, smart people creating future value annuity table, FVA table equals a future value of annuity, right, table. And so you use the $10,000 multiple 3.31, you get the future value of annuity of $10,000 for 3 periods. Okay? Okay. So future value of annuity due, let's do it one by one. So the first payment is at the year 0. So you were calculating the first $10,000 by the end of year 3. You will find the future value table of I equals 10 and n equals 3, right? And the second period is having future factor actually investing 2 years. So this is n equals 3, this is n equals 2, and this one is n equals 1, right? So therefore, if you look at the closely, the first payment, you will find the future factor of n equals 3. So it's a 1.311. And then you got the future value at the end of the year 3 is 13,310. And the second period, the n equals 2 at the 10% return rate, use 1.21, so the future value is $12,100. And the third period, instead of multiple 1 like last time, an ordinary annuity, this annuity due, you multiple 1.1 because n equals 1 right now. So therefore, the future value is 11,000. So if you're adding the future value factor together, you know the annuity due 3 years at 10% return is 3.641. So smart people gonna come up with a really good table, which in your book it should be table 5. You call the future value of annuity due $1. I will abbreviation from now on from future value of annuity due as FVAD. Okay, so therefore you can look for that table. You will find this factor. Okay, 3.641 factor, and you can quickly calculate it. $36,410. Okay, so after we talk about the future value of either ordinary annuity or ordinary annuity due, I wanted to talk about the present value of annuity due. So why do you need to know how to calculate in present value of annuity due? For example, this is a great scenario. Okay, Rita Grant wants to accumulating a sum of money to pay for graduate school, and she wants to invest in a single month today. Okay, in a saving account to earn 10% of interest compounding annually. That is equivalent to investing $10,000 at the end of each period for next 3 years. So in other words, instead of paying $10,000 at the end of instead of saving every year for $10,000 at the end of the year, she wanted to know how much she can put in the bank right now, can save exactly same amount at the end of the year 3, right? So you have two ways. One, you can save $10,000 each year, right, at the end of each year, or you can put a lump sum in here and find out how much money in the 3 years. So therefore, it's essentially is calculating the present value of the cash flow of these 3 years. So we know how to calculating each batch of cash flow, right? So $10,000 from year one from now. So basically, first payment, if you discount into current period, you will learn to remember to use the present factor 0.909. That means that the present value is $9,091. And the second payment, the $10,000, happened on the second year end. So the present discounting factor is 0.8245. So therefore, the present value is 8,264. And the third payment is to happen in the third year. So the discounting factor is 0.75. So therefore, the present value is $75,013. So therefore, smart people are gonna add up all those discounting factor, and then they will call it the present value annuity, ordinary annuity discounting factor, right? Okay, so we call it the present value annuity table, and then this table is gonna be on your book as well. So it looks like this. You have the I number and you have a number of period, right? So if you discounting at 10% and the period of 3 period, that means that you can use annuity of 10,000 multiple annuity present value factor to calculating the present value of 3 equal $10,000 period in the 3 period in the future, right? So now the relationship between the present value and the future value annuity is very clear. So if you invest in $10,000 at 10% each year for 3 years, you will have a future value of $33,000, or you can invest in $24,868, and then you can have the same amount from now. In other words, the discounted value of a future cash flow to current and is gonna equals 24,868. Okay, so let's look at the present value annuity due. It's the same thing, but just the only difference is that the present value, if you want to calculate in here, the first payment is gonna multiple 1 because the first payment is happen on that day, beginning of each period, and right on that discounting day, right? So therefore, this is the things that you need to pay attention. And then the second period is only have discounting period of n equals 1, and third payment is only have n equals 2. So if you calculating each payment using discounting table, you find out that actually the annuity due present value factor is 2.73554. So in other words, if we use the PV present value annuity due table to calculating present value of annuity due, that means that we also can use a table 6 to find out how much the present value of annuity due is in lightning speed, right? So table 6 is showing us the PVAD table, which is present value of annuity due. We can find that discounting rate or annuity factor rate. And so the next thing we wanted to look at is what is the present value of a deferred annuity? What is deferred annuity? Deferred annuity exists when the first cash flow occurs more than 1 period after the date of agreement begins. For example, at January 1st, 2021, you are considering requiring an investment that will provide 3 equal payments of $10,000 each to be received at the end of the 3 consecutive years. However, the first payment is not expected until 2023. So in other words, that you want to invest in money here, but the first payment is not until 3 years later, and then you are requiring 3 payments. It's like a pension, right? You're investing a lot of money for like 20-30 years, and then you don't require the first payment until say you are 65. but after that you require to consecutively paying you equal amount, right? So this is just a very simple analogy of that kind of situation. So how do we do this then? What is the time value of the money of how much would you willing to pay for this investment if you have this kind of setup, right? So there's a two-step involved. So first, simply put that you can discounting each payment back to the beginning. So basically you discounting the first payment using n equals 3 because 1 to 3 period, and you discounting the second payment using n equals 4, and you use a third payment discounting the n equals 5. That's one way to do it, right? So like here, and then you can find out that the present value is 20,552 to realize this investment arrangement. However, there's another way to do that. It involves two steps, which is much easier. So first steps is that you consider that you calculating present value of annuity as of the beginning of the annuity period, meaning that how about I just think about this consecutive payment as the first period, the first day of the first payment period. I discounted this value right here first. And then I use this so-called discounted value to discounting back to real present value of today, say in investment, right? So let's say present value at the beginning of annuity payment, that's the first step. And then you discounting this money back to the present. So how do we do that? So first thing, you wanted to use a present value annuity table using $10,000 only multiple 3 period, right? Because you want to calculating at the beginning of the first annuity payment, and there's a three payments, so you discounted to everyone discounting to here, right? And then after that, you know that this $24,868 is actually 2 years from now's value. So that means that you have to discount it back to today, which is January 1st, 2021. So then you use the $24,828, treat it as a future amount at a discount rate of 10% and a period of 2. And then that way you find that present value of a single amount table, and then you find that the rate is 82645, and then you find the present value is actually $20,552. Okay, so also I said in the beginning of class you need to buy the Texas Instrument model of a financial calculator. So here I just kind of quickly talk about what each button meant. The button N means number of periods, and then percentage I it means interest rate, and the PV is means present value. FV means future value. PMT means annually payment, which is annuity. And CPT means the compute button, right? So example, if you assume you need to determine the present value of a 10-period ordinary annuity for $200 using 10% interest rate. So the I equals 10%, N equals 10, and the payment equals 200. So what you do is you enter N first, and you enter I interest rate first, and then you enter PMT button, put a minus 200, and then you press CPT and PV, right? And then you can compute is the CPT button, and then press the PV button. You can find this $1,229. Okay. And also Excel, I will show you guys how to use Excel at the class. So here I'm not gonna talk about the too detail. Basically, there's a function called the PV function, and you can put the parameter into this PV function. You can quickly calculate it. I will use at the class. I will show you guys how to do it. Okay. So next section of the material, I wanted to talk about the things that like we did in the section, first part of section, is that we know the future, we know remember, we know the future, we know the present, we know the n, we don't know the I, right? Or we know the future, we know the present, we know the I, but we don't know the n. So similar here. Now we wanted to learn that we know the annuity, but we don't know either I, which is return rate, or n. So let's look at this first example. Assume that you borrow $700 from a friend and intend to repay the amount in 4 equal installments beginning 1 year from today. So from this sentence, we know that this is gonna be ordinary annuity case, right? It says very clearly. And your friend wishes to reimburse for the time value of the money at the 8%, so I equals 8%, right? It says 1 year from today. This beginning 1 year from today, it means end of the year today, so it's ordinary annuity, right? And what is the required annual payment that must be made to repay this loan? So basically, we know that I equals 8%, and we know n equals 4, and then we know that present value equals 700. So right now we wanted to know the annuity pay, ordinary annuity payment. So remember the present value of an ordinary annuity, PVA, right, equals the annuity amount multiple the present value factor, annuity factor, right? So here we know that the PVA is 700, and then we want to calculating annuity, and then we can find the corresponding 8% for period. This is known as well in table 6. So then the question mark is easy to solve, right? So in other words, in the table 6, we know the 3.31213 is the annuity discount factor at 8%, n equals 4. So therefore, annuity amount should be using $700 . So let me write here. So present value of annuity equals annuity multiple the PVA factor, right? So we know that the PVA is 700, annuity is unknown, and this factor we know is at n equals 4 and equals 8, 3.31213. So the annuity equals $700 divided 3.31213, right? So we know that every year here is $211. Okay. So what if we don't know number of periods? We know the annuity, which is $100. We know the present value, and we know the return rate. How do we know how many years took it to repay the loan? Okay, let me read here. Assume that you borrow $700 from a friend and intend to repay the amount in an equal installment payment of $100 per year over a number of years. The payment will be made at the end of each year, beginning of year 1 from now. So basically ordinary annuity, right? So at end of the year 1, right? So the friend wished to be reimbursed of time value at 7%. They want to charge you 7% interest rate. So that means that then you wonder how long will it took you to pay this $700 off. So same thing, you know the present value of the annuity, and you know it's 100 annuity, and then you want to know what is the rate. But within this rate, you have already know the n is the question, but I is actually 7%. So that means that you can use the 700 divided 100, right? And then you can calculating this present value of annuity factor. And then if you go to the column, the PVA table factor, right? So basically you can find the number 7, and then you find the column. The column started with the 7%, and then you wanted to find the 7, and then you will find that the n equals 10. So in other words, that in table 6, once you find the discounting factor should equal 7 and should be in the column of I equals 7 column, then you will find that it will take you 10 years to pay him off of the loan. Okay, so similarly, what if we know PVA, we know A, we know N, but we wanted to know I, okay? So let's say that you, suppose a friend asks to borrow 331 today, right? And then it promise you to pay you $100 each period, and then for next 4 years. So the PVA factor. So in the table, you know that it has to be stay in the n equals 4 factor, right? So you just want to know what is I here. What is I here? So therefore 331 dividing 100 equals 3.31. So on this row, n equals 4 row, you probably need to find the factor 331 factor and find what is the interest rate, right? So that's in table 6. So here it showed us the annuity discounting factor if it's a PVA table factor 3.31 in the which is table 4, and search for the row 4 n equals 4, and then you find it's actually point at 8%. So in other words, this thing I draw here is 8%. Okay, so that's how you back out from the unknowing i's. Okay. So now let's look at the long-term bond. Remember, actually in the financial accounting, we kind of talk about it in chapter 10. And we wanted to always ask the present value, which is the issue price of the bond, right? Okay, so let's look at this example. On June 30, 2021, Fumasu Electronic issued a 10% stated rate bond with a face amount of 200 million. The bond mature on June 30, 2041, which is 20 years. The market rate of interest for a similar issue was 12%. The interest paid semi-annually at 5% on June 30th and December 31st, right? So it's a semi-annually, and the face with a face interest rate of let's see, with a market interest of 12. So we know that market interest is a real discount rate, right? So and then the face interest rate is 10%, and then you know that the payment is actually paid a half year, so basically dividing 2 is 5%. So always paying on 30 and 31 at the beginning of December 31st, 2021. So therefore, it's an ordinary annuity because it borrowed on June 30th, 2021, and the first payment is not until December 31st, 2021. So and so on and so forth for 40 years, right? So that means the interest payment of 10 million, which is a 5% multiple 200 million. So that means the annuity, ordinary annuity is a 5% multiple 200 million. So which equals to 10 million, right? And the interest rates I equals the 12% dividing 2 is a 6%. And the number of payments is 20 years, but pay semi-annually is 40, right? So n is 40 periods. So now we can find out using the present value of an ordinary annuity table of $1 n equals 40 because it's paid semi-annually, right? So this interest is paying twice a year. So there's a 20 years loan, that means you pay 40 period. And the effective rate should be 6 because market rate is 12%. You need to divide in 2 because it's a half year every time. So then you find out the 10 million of ordinary annuity multiple the discounting factor of 15% of a present value annuity. That means that the interest payment discounted to today from 40 years from now is actually equals $150,463,000, right? At the same time, the PV, which is 200 million, you also have to find the discounting factor of a 40 period at the discounting factor of 6, but a single amount discount, right? It's two portion. One is your interest present value. A second one is the principal present value, right? I think this is covered in financial accounting. So therefore, you have to discounting interest to present. At the same time, you have to discount the principal to the present. The interest, in order to discounting to present, you use the annuity table, present value annuity factor. But for principal that you discounted to currently, you only use a present value of a single month table. And that means that if you are $200 million 20 years from now paying 6% effective rate for 40 times, that's equals to $19,444,000. So if you add this together, then you know that today you should issue this bond at $160,907,000. Okay. Okay, so the long term, now we wanted to look at the example of long-term lease. Long-term lease, is the difference is that usually you have to pay at the beginning, right? So that means that if we use anything, we should use a present value of annuity due table, right? Let's look at this example. On January 1st, the Stridewell Wholesale Shoe Company signed a 25-year lease agreement for office building. The term of the lease called the Strider to make an annual lease payment of $10,000 at the beginning of each year. So when we read this sentence, beginning of each year, we know that if we want to discounting this $10,000 for 20 years, we needed to use the PVAD table, right? Or an annuity due table with the first payment due on January 1st, 2021. Assume an interest rate of 10%, I equals 10. So I equals 10%, N equals 25, and then we know we use a PVAD table. Okay, and then they wanted to know how should value the asset acquired and corresponding lease liability. So basically, PVAD table, you find that in that PVAD discounter factor table, you find N equals 25 and I equals 10 is 9.98474. This is a factor. Multiple annuity amount of $10,000. You find that the present value of the leased asset is $99,847. So if you trying to record this asset, you should debit right to use the assets, right? It's still an asset, but it record the right to use, not asset itself. For $99,800, and then lease payable for $99,847, right? Okay, so let's see another example. Valuation of installment notes. On January 1st, 2021, Stradwire Wholesale Shoe Company purchased a $35,000 machine with a $5,000 down payment and the 5-year installment notes for remaining $30,000. In other words, this machine worth $35,000. They paid $5,000 down payment already, and they owe $330,000. The term of the note caused Strideware to make annual installment payments at the beginning or at the first payment due on January 1st, 2021. So this is also annuity due example, right? And at each of December 31st thereafter, assuming that an interest rate is 4%, so the amount of annuity payment. So they wanted to know that how much we have to pay the annuity due to have a present value of annuity equals let's see, you know the left hand side of the equation is $30,000, right? And this is the unknown, and then you know that the factor here you should look for I equals 4% and n equals 5. So therefore you find that this factor is equals 4.6299. So therefore you move this one to the left hand side, and the annuity pay, you have to pay installment payment should be 6,480, right? So the journal entry for the initial purchase, which is gonna be January 1st, 2021. So your debiting machine for the whole $35,000. You credit in cash, which is the payment, down payment. You credit a notes payable, which is $30,000. And then when you pay the first installment payment, you were debiting notes payable and crediting cash for $6,480, right? Okay, so that's the first payment. And then there's no interest is needed for the first installment payment because no time has yet passed. Because annuity due is you pay the first payment on January 1st, 2021. So the same day you purchase this, the same day you pay the installment payment, right? That means that you don't have interest. However, when you record the second installment payment, you have interest expenses, right? So that is equals to the principal, which is $30,000 minus the one you paid, and multiple 4%, which is the rate, is $941 as interest expenses. And then the cash still stay at the 6,480, but the notes payable, which is the principal reduction, is only $5,539. Okay, so now let's look at another example, like a valuation of pension obligation. So on January 1st, the Stridewell Wholesale Shoe Company hired Terry Elliott. Terry is expected to work for 25 years before retirement on December 31st, 2045. And the annual retirement payment will be paid at the end of each year. So therefore, we know that it's ordinary annuity, right? Expected for 20 years. So the first payment will be due on December 31st of 2046. During 2021, Terry earned an annual retirement benefit of $2,000 per year, and the company plans to contribute the cash to a pension fund that will accumulate to a amount sufficient to pay Terry's this benefit. So basically, starting from 2040, every year Terry wants to get $2,000 every year, right? So this you wanted to discount into 2021, January 1st, 2021 here, right? So, and then assuming that the effective rate is 6% on all funds invested in the pension plan, how much would the company have to contribute at the end of 2021 to pay for pension benefit earned in 2021, right? So basically, annuity is $2,000, and the I is 6%, and the N is gonna be 25. So the question is, what is the present value of the ordinary annuity? So look at here. So at the beginning here is this two-step process, right? So if you have annuity for $2,000 for 20 years, right? And then you have an annuity of $2,000 and for 20 years, so that means that you will find the present value of ordinary annuity n equals 2, I equals 6 is $11.4699. So therefore the present value at here is equals $22,940. But this amount needed to be discounted to today. So present value of 2294 also need discounted the number of 24 years. So therefore, this discounting factor is $1 at a single amount of n equals 24 period, I equals 6, and it's actually only 0.24%. So then you multiple this rate, multiple 0.24698, then you find that the present contribution should only be $5,666. Okay, so now we finish chapter 5. First of all, there's a present value of $1, a single amount, right? And there's a present value of ordinary annuity and present value of annuity due. This is a three totally different concepts, but the trick and the play of all of them is the same. And I hope from Learn Smart and my lecture recording, you can have a bigger idea about what's going on. And then during the class, we're going to do more specific exercise. So I will see you guys in class. Thank you very much.